Today, we're jumping in the time machine and heading back to 1990. We're going to deconstruct a year that Warren Buffett, one of the greatest investors ever, called lackluster. But as we're about to find out, digging into this old shareholder letter uncovers a masterclass in business and investing that is frankly more relevant today than ever.
So let's start with a number, 7.3%. That's how much Berkshire Hathaway's net worth grew in 1990. Now, for pretty much any other company on Earth, that's cause for celebration, right? The CEO would be popping champagne. But this isn't just any company, and Warren Buffett isn't just any CEO.
So, what was Buffett's own take on this? He called a 7.3% gain lackluster. And that's the central mystery we're going to solve. Was 1990 really a bad year for Berkshire, or was Buffett seeing a completely different reality, something hidden just beneath the surface?
To get to the bottom of it, here's our game plan. First, we're going to challenge that whole lackluster idea. Then, we'll pop the hood and look at Berkshire's core businesses. We'll uncover the financial magic behind their insurance operations, see how Buffett was investing when everyone else was freaking out, and then we'll wrap it all up with some timeless wisdom that honestly applies to all of us.
All right, so let's tackle that first big question. Was it really such a lackluster year? This is where Buffett pulls back the curtain and shows us why that headline number, that 7.3%, doesn't even begin to tell the real story.
To really get the picture, Buffett introduces this incredibly powerful idea he calls look-through earnings. Think about it like this. Normal accounting is like only counting the apples you actually pick from your orchard. But Buffett says, wait a minute, the real value is in counting the new trees that are growing, all the earnings that the companies Berkshire invests in keep and reinvest to get even bigger and more valuable down the road.
And check this out. Officially, Berkshire reported earnings of $371 million. But when you look through to their slice of the profits that companies like Coca-Cola held onto, the true economic gain was almost $590 million. That is over 50% more value created for shareholders that standard accounting just completely ignores.
But here's the thing. Berkshire's real strength isn't just its stock portfolio. The true foundation is its collection of businesses that it owns outright. This is the operating engine that just churns out these incredible profits from what seem like really boring, everyday industries.
And the secret sauce? It's an absolute obsession with efficiency. Look at this. Borsheim's Jewelry and the Nebraska Furniture Mart were running with costs that were less than half of their competitors. This isn't just a small edge. No way. This is a deep, structural moat that lets them offer lower prices and still make amazing profits. They just dominate their markets.
Buffett just crystallizes this whole philosophy with this one line. What works with diapers works with diamonds. It doesn't matter what you're selling. The core idea is always the same. A relentless, ruthless focus on low costs creates this amazing cycle of high sales and real market power. It sounds simple, but actually doing it, that's genius.
Okay, now we're getting to the financial heart of the whole Berkshire empire, the insurance businesses. This is where the capital comes from, right? This is the dry powder that fuels all of Buffett's legendary investments. And the secret ingredient is this thing called the float. It's actually pretty simple. It's the huge pile of cash that Berkshire collects from insurance premiums. They get to hold on to it and invest it for themselves, sometimes for decades, before they ever have to pay it out in claims. It's basically like getting a giant, long-term, interest-free loan to go play with. And this table just shows you how mind-blowingly powerful that is. In 1990, Berkshire had over 1.6 times billion dollars of this float, and it only cost them 1.63%. Now, at that same time, you could get over 8% on a risk-free government bond. It was an unbelievable advantage. And look at some of those other years. Sometimes their cost was negative. They were literally getting paid to hold and invest billions of other people's money. It's just wild.
And, Berkshire just played the insurance game on a different level. With their supercat business, they didn't try to avoid risk, they ran towards it, insuring against massive, once-in-a-lifetime catastrophes. They knew it meant their earnings would be all over the place, but like Buffett said, they'd rather have a lumpy 15% return to a smooth 12%. They were just playing a much longer game than anyone else could afford to.
So you've got all this super low-cost cash from the float. What do they do with it? Well, this brings us to the most famous part of the Buffett playbook, being a true contrarian.
To set the stage, Buffett borrows a line from the philosopher Bertrand Russell, because to be a successful investor, you can't just follow the herd. You have to think for yourself. And in 1990, believe me, the herd was in a full-blown panic.
So his first big move was buying into Wells Fargo. The entire market was freaking out about bank stocks, terrified of a big real estate collapse. But while everyone else was reacting to fear, Buffett was just calmly looking at quality and price. He bought a huge chunk of what he thought was the best-run bank in the country for less than 5 times its earnings. It was an incredible bargain, just sitting there in plain sight.
Okay, but if you thought that was a bold move, his second one was even more contrarian. The so-called junk bond market had totally imploded after the craziness of the 80s. It was a disaster zone. But right there, in the middle of all the wreckage, Buffett analyzed the bonds of RJR Nabisco, realized the panic was way overblown, and plowed $440 million into them. He saw that the potential rewards were way bigger than the perceived risks.
So we've looked at the numbers, we've seen the big moves, but what's the underlying philosophy here? Let's try to distill the big ideas from this letter, the kind of timeless wisdom that every single one of us needs to understand.
You know, it all really boils down to 3 words he got from his mentor, Ben Graham. Margin of safety. That's it. It's the single most important concept in investing. All it means is buying something for way less than you think it's actually worth. That's why he bought Wells Fargo at 5 times earnings. That's why he bought RJR bonds in a panic. It is your ultimate protection against a future you can't predict.
And that leads us to this brilliantly counterintuitive mindset. Look, if you know you're going to be buying investments for the rest of your life, then falling prices are your best friend. A market crash isn't a crisis, it's a sale. It's a chance to buy more of a great business for less money. And that is exactly why Buffett says that for a rational buyer, it's optimism that is the enemy.
And that really leaves us with one final question to just sit with. When the market is plunging and the news is filled with panic, what do you see? Do you see risk or do you see opportunity? Do you focus on the falling price or do you focus on the underlying value? Your answer to that question, well, it says everything about your mindset as an investor.